This is part three of proactive risk-taking and value investing. In the previous tape, I talked about how one could predict the future free cash flow, the, the funds that a company would use to pay dividends, to pay down debt, to make acquisitions if that would improve their future profitability. That is, the free cash flow is exactly that, free. Now, if a company buys back its stock because they have cash available, they usually buy it back when it's overvalued. So you can't trust the management to know how to use their free cash automatically. What you have to do in predicting the future, apart from looking at the quality of management, the way they've used their free cash flow in the past, is to look at the value of what they own. In the case of Procter & Gamble, in the case of Johnson & Johnson, they had very valuable patents, trademarks. They have businesses with a recognizable name. People will buy their products because they've invested so much in past publicity, in building a loyal following. However, these stocks are generally overpriced. They do generate free cash, and they will in the future. But you're paying a lot of money for each dollar of free cash. That's not a bargain. When you listen to CNBC, which is basically a very valuable source, you have to determine what a valuable franchise is. When you hear people talk about a place to hide that is in a bad market, what kind of stock to buy, because you can be sure they'll still sell soap or they'll still sell Band-Aids. Don't listen. If they wanted to hide, they could hide in cash. Cash is what you can use to buy things when they're on the bargain counter. And Procter & Gamble is not on the bargain counter. And neither is Coke. And neither are these other big brands. However, what has been underestimated over the last 10 years is the value of oil and gas reserves owned by companies, that is, future production. Now, oil and gas companies, producers, have had a big run. And while they're not overvalued, they've run up quite a bit. If you assume that natural gas in the future would sell not for the current price of $13, but on average for $8. If you assume that oil would sell not for $140 a barrel, but for $85 a barrel, and these are very conservative assumptions. Apache Corp, which is a Houston oil and gas producer, a very good company, would have a present value of $180 a share. And it sells for $135. But it's not a good buy. Because when the benchmark oil price comes down, and I think it will in the next 6 months, these stocks are going to go down even more than the price of oil. And that is the time when they will be bargained. So Apache could go down to $100 a share. And if its present value is $180, that's a real bargain. There's another Houston company, Swift Energy, that nobody's heard of. It's probably worth $75 a share, and it will be selling for $40 when oil goes down. But if you're just starting out right now and you're sitting on cash, you have a real opportunity to wait. Over the last 15 years, I've started out with an account, an online account of my own, because by 15 years ago, amateurs, the commissions were low enough for amateurs to be able to play. And then after 5 years, my niece and I had a joint account. And then 7 years ago, we divided the account. I used the accumulated funds to live on because I wasn't working. And I kept managing her account. So over the 15 years, I have a return of roughly 20% annualized. Over the last 12 years, it's about 23% annualized. This puts the return roughly in the upper 1% of all mutual funds. And since January 1st of 2008 to the end of June 2008, I was up 21%, while the average, market averages were down roughly 12%. And 1,950 mutual funds listed in Barron's out of 2,000 lost money. Now, why was I able to do this? I mean, I'm pretty bright, but I'm not that bright. What I am is an amateur. And while these people can't sit in cash because their mandate says they're supposed to stay fully invested, they're buying bad stocks. They're hiding out in a lot of no-growth stocks when they could be sitting on cash waiting for opportunities. At the end of June, I sold 100% of my niece's holdings. This is the only account I trade on. In the first half of the year, I lost money on 36 stocks, and I made money on 30. But the winners were much larger than the losers, and that left on a $212,000 base, she ended up about $42,000 ahead. At the moment, I'm 100% in cash in her account. So what am I looking at? If you look at a financial company, you look at the liquidation value. What could they sell their assets at? In the case of Citicorp, which was considered to be a bargain, they've been getting new capital, and they keep finding loans that are no good. So Citicorp probably has a liquidation value of maybe $15 a share. So even though it's dropped 65%, it's not a bargain. If JP Morgan goes down to about $25 a share, it will be selling at the value, at roughly the value of its tangible capital. And if Berkshire Hathaway, an insurance company that generates much cash, goes down to $3,500 a share, that will be valuable. The things not to believe is that there's a world growth story, that the world's not going into recession, because I think it probably is. The people of India are not going to be a growth engine. They drink filthy water. They have streets littered with cow shit. And my dogs and my cat have a much higher living standard and probably better health than the average Indian. And the people of China are going to be suffering from emphysema because they're breathing coal dust constantly. So anything having to do with the weak dollar or with world growth is not a good prospect. The end.